So, you've got a client with a Roth IRA excess contribution from a prior year. You know it, and I know it. It's one of the trickiest compliance knots there is to untangle. Well, today, we're going to do a deep forensic dive. We're going to pull on all the right threads using IRS Form 5329 Part 4 as our map. Let's get into it.
Here's our game plan. We'll kick things off with that nasty 6% excise tax. Really get under the hood of how it works. Then we'll play detective and diagnose the root cause of the problem before walking through the five methods you have in your toolkit to fix it. From there, we're going line by line through Form 5329, and we will master the NIA calculation. And to wrap it all up, we'll look at some key legal precedents and strategic plays that can actually turn this headache into an opportunity for your client.
All right, first things first, let's lay the groundwork. We have to talk about the penalty itself. I mean, why does this thing even exist? And what gives it so much teeth? You've got to understand, this is not just some simple slap on the wrist. It is a powerful and, more importantly, recurring penalty with a very specific legal framework behind it, all designed to stop people from gaming the system. And here it is, the heart of the matter, this 6% figure. It is absolutely crucial to grasp that this is not an income tax. It's not a one-and-done early withdrawal penalty. No, it's an annual excise tax. And it was specifically designed to be just painful enough to make sure people don't intentionally overfund their retirement accounts.
Now, if there's one phrase I want you to burn into your memory from this, it's rolling liability. This is where a tiny little mistake can snowball into a massive problem. See, it means that 6% tax gets charged again and again. Every single year, the excess cash is still sitting in that account on December 31st. Just imagine a $6,000 mistake from 5 years ago. That's not a one-time $360 hit. No, that's $360 a year for 5 years straight, and it just keeps coming until you make it right.
And look, this isn't just the IRS making up rules as they go. The authority for this tax comes directly from the law. Specifically, Internal Revenue Code Section 4973. This is the statute that lays it all out. It imposes the tax and sets the rules for everything we're about to discuss. Knowing this code section is your foundation when you're dealing with the IRS on this issue.
Okay, so we can't fix a problem until we know exactly what caused it, right? In my experience, these excess contributions almost always boil down to one of three common scenarios. So let's put on our forensic hats for a minute and go through the usual suspects.
So what are the big three? Well, the first one's the most obvious. Your client just plain put in more money than the annual limit allows. The second is a bit more subtle. They made too much money and got hit by the income limits, what the IRS calls the MAGI phase-outs. And the third, which can be kind of sneaky, is a botched rollover or conversion that accidentally gets coded as a regular contribution.
And here are those dollar limits for 2025 and 2026, just so we're all on the same page. For 2025, you're looking at $7,000 or $8,000 if you're 50 or older. For 2026, it pops up to $7,500 and $8,600. Now, here's a pro tip, something I've seen trip people up time and time again. These limits apply in aggregate across all their IRAs, traditional and Roth. You can't max out both.
Okay, now this is where it gets tricky, especially for your high-earning clients. As their income climbs, the amount they're allowed to put into a Roth IRA starts to go down, and that income is measured by something called MAGI, or Modified Adjusted Gross Income. Just think of it as regular AGI but with a few deductions added back in. A surprise year-end bonus, a big capital gain, that's all it takes to push a client into this phase-out range when they totally weren't expecting it.
All right, we figured out the what and the why. Now let's talk about the how. As a professional, you've got 5 primary tools in your toolkit to correct an excess contribution. And listen, each one has a different timeline and, more importantly, very different tax consequences. Knowing which tool to pull out for which job is absolutely critical.
So what's in the toolkit? First up, you have timely corrective distributions. Think of this as your undo button. Then there's the untimely withdrawal, which is a different beast altogether. We've also got a pretty slick method called absorption, which lets you use a future year's contribution room to clean up the past. And of course, you have your standard ordinary distributions and the old standby recharacterization. Now, the absolute best, cleanest way to fix this mess is with a timely distribution under IRC Section 408D4. This is the gold standard. Why? Because it lets you treat the contribution as if it never even happened. The 6% penalty? Poof, gone, but. And this is a big but. The rules are incredibly strict. You have to pull out the exact excess principal, plus any earnings it generated, and you have to do it by the tax filing deadline, including extensions.
So using that timely method is our best bet. But how do we actually prove to the IRS that we cleaned everything up? And, what happens if we miss that deadline?
Well, that's where Form 5329 comes into play. I want you to think of Part IV of this form as the official ledger. It's where you document the problem, report the fix, and calculate any penalty that's due. So let's break it down, line by line. We're not going to look at every single box, just the heavy hitters, because these lines tell the whole story. Line 18 is where last year's unresolved problem shows up. Lines 19 and 20 are where you show what you did this year to fix things. Line 23 is where you confess to any new mistakes made this year. And then lines 24 and 25 are where you do the math and figure out the final damage, if there is any. Right here is the perfect example of that rolling liability we were just talking about. Your entire calculation for this year kicks off on this line, and it literally just pulls the uncorrected number from line 24 of last year's form. This is why it is absolutely positively critical that you keep copies of prior year 5329s for any client with this issue. Without that form, you're flying blind. Now check this out. This is a really important bit of taxpayer protection built right into the form. The 6% tax isn't just on the total excess, it's calculated on the smaller of two numbers, either the total excess contribution or the fair market value of the account at year-end. This is what's known as the FMV Cap, and it's basically a fairness rule. It means if your client's investment tanked, they don't have to pay a penalty on value that doesn't even exist anymore.
Okay, let's roll up our sleeves and get into the most technical part of this whole process. It's what's required for that Pillar 1 timely correction we talked about, calculating the Net Income Attributable, or NIA. This is the exact amount of earnings or losses that you have to take out along with the original excess money to make the correction valid in the eyes of the IRS.
Here it is, the formula you have to use, straight out of Treasury Regulation 1.408-1. And no, it's not optional. This is the one and only required method. Now, the most fascinating part of this formula, the part that trips up so many people, is that the earnings are based on the performance of the entire account during the period, not just the performance of whatever stock or fund those specific excess dollars bought.
So the first variable you need to find is the adjusted opening balance. It's actually super simple. It's just the value of the account right before the mistake happened, plus the amount of the mistaken contribution. So if the account was worth $100,000 right before a $7,000 excess contribution, your adjusted opening balance is $107,000. Easy enough. That number goes on the bottom of our fraction.
The second variable is the adjusted closing balance. And again, it's pretty straightforward. This is simply the value of the entire account right before you take the money out to fix the problem. The difference between this closing number and that opening number we just talked about, whether it's a gain or a loss, is what will ultimately determine the net income attributable that has to come out. All right, we've gone through the mechanics, we've done the math. Now let's elevate our thinking. Let's move beyond simple compliance and into actual strategy. Because this, right here, is what separates a tax preparer from a trusted advisor. Understanding the key court cases and how all these rules interact can help you give your clients some seriously high-level advice. I love this quote. It's from a landmark tax court case, Paschall vs. Commissioner. And the court made a huge ruling here. It established that Form 5329 is its own separate tax return. Now here's the bombshell for us. What that means is, if your client doesn't file Form 5329 to report an excess contribution, the statute of limitations never starts running. Ever. The IRS can come back and assess that 6% penalty years, even decades down the road.
And that brings us to the most advanced topic, strategy. Believe it or not, the right move here depends entirely on how the investment is done. If your client has a loss, a timely correction is almost always the way to go. Why? Well, the NIA formula will be negative, meaning they have to withdraw less than the original excess, which effectively forgives part of their loss. But what if they hit a home run? What if they turn that $7,000 excess into $50,000? Well, it might actually be smarter to intentionally miss the deadline, pay the 6% tax just once on that $7,000 principal, and then use the absorption method to fix it next year. That could potentially lock in all those massive earnings inside the Roth, tax-free forever.
So here's the bottom line. We're not just talking about fixing mistakes anymore. When you have a deep, forensic-level understanding of Form 529 and all the rules behind it, you can start to ask much smarter questions. Which brings us to our final thought for the day. The next time you see one of these cases, don't just ask yourself, how do I fix this? Instead, I want you to ask, when does paying the 6% penalty stop being a penalty and start being the price of admission for a brilliant strategic move?